Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. I'm kind of on an income kick here this week because yesterday I presented a video where I covered four what I could call high-yielding, very undervalued REITs, real estate investment trusts. And, these are kind of unique products relative to the normal standard blue chip, say Dividend Aristocrat or Dividend Champion. But another unusual capital structure would be master limited partnerships, or what are referred to as MLPs. And the one I'm going to be featuring today is Enterprise Product Partners. It's one of the highest quality MLPs out there. It's an energy company, but I'm going to kind of get into that in a little more detail here because it's really very well diversified and has long-term appeal. I've been asked several times, how come I don't really cover energy stocks? Well, if you're looking at your mainstream Exxons and Chevrons and, what I would call typical oil and gas producing energy companies, I'm a little bit reticent to show those because clearly there's been a lot of political pressure and a lot of things happening in the general energy sector. But the master limited partnership, especially in the distribution and pipeline sector, are very, very interesting and relatively stable. And so we're going to look at one today. Now, there's some issues. They do come with a K1. And a K1 does have the potential, or the master limited partnership may be a better way of saying it, does have the potential to generate unrelated business tax income, especially in IRAs and retirement accounts. But that's really not something that most individual investors will face. And this particular company has actually had negative UBTI, but there is a recapture that can happen depending on how you sell it. But the key is these aren't trading vehicles. The idea here is that you want to invest in an MLP primarily for their income. Very similar to REITs, these are primarily income producing stocks. Enterprise Product Partners yields 8.23% as of yesterday's close, and it has 22 consecutive years of increasing the technical word is distribution, but I'm going to use the word dividends just because it rolls off the tongue easier throughout the rest of this presentation. This is a very unusual company. There's some interesting aspects about it that I'm going to kind of go over as I go through the video, but it's also one that I consider to offer an extremely high margin of safety today, which is very, very difficult. And that has to do with, I think, the politics of the new Green Deal energy, situation as it, relates to the world as well as, of course, especially in the United States here. So we're going to look at this really high quality master limited partnership called Enterprise Product Partners. So let's go ahead and get into the video and look at it. Now, there's some interesting things here that I'm going to talk about and show you about this particular limited partnership. And by the way, for disclosure, I'm actually long this particular MLP. This is the operating cash flow picture, and I want you to see something very interesting here. Look how the operating cash flows increased dramatically. There's a very interesting reason why and how that happened. But I also want you to note during that time, their dividend grew from $1.02 to $1.08 to $1.14. Okay, and that was, in spite of the fact that they had this huge surge in operating cash flow. And then, of course, it went back to more normalized numbers after that. And I'll show you what they did. This is coming right out of the Great Recession. And I'm just speculating on what they did, but I'll cover what I think they did anyway as I go through that. But otherwise, I also want you to note that the white line in this graph is the distribution line, or the dividend line, as I call it. And the area below that is the portion of the company's operating cash flow that were paid out in dividends. Now, every now and then, they get to where the payout ratio gets pretty high, and I might have to take price off the graph so I can hit this for you, where it actually exceeded 100% in 2005. But otherwise, the dividend payout ratio, has been as low as 25% when we had this very big surge. But otherwise, we're looking at, pretty reasonable dividend payout ratios all around. All right, so the main point is that the dividend is well covered by operating cash flow throughout this period of time, and it was creatively covered during this coming out of the Great Recession, which I'll get into later. Now, I also want you to note that the stock price correlates very closely in this particular MLP to the company's dividend. In fact, the dividend line becomes almost one of the best valuation references that you could have. In other words, when the price is below the white line, it's a great time to buy it. When the price is above the white line, that's a less than optimal time to buy it because the stock price always tended to go back to that white line. But again, this company is currently yielding over 8%, and it's trading at an extreme discount to what I would consider its intrinsic value to be. And I'll get into that in a little more detail here going forward. But this company, I'm using a priced operating cash flow of 15 as a kind of a regular valuation line. The normal market value line that the market has typically applied has been closer to 11. But even then, I want you to note that there's a strong margin of safety here, defined as the company's price trading significantly below what the fundamentals, the operating cash flows, based on normal market values would suggest. Okay, so this would suggest about a $38 price, and the stock currently trades at just under 22. So that's what I mean by the strong margin of safety. But I do want to do something here. I want to go into, one of the things that you do with stocks like this, especially this one, is you want to go into these external links here. And I've done that because I've researched this pretty thoroughly. And as I mentioned, I am actually long on it in accounts of mine that I manage there where clients are really looking for that current income, where they need that current yield, and who are either using a tax advisor or aren't concerned with the nuisance of a K1. And that's really, I think, overinflated in a lot of people's minds, because a K1 can be dealt with rather easily. And, I always have an old saying that says, don't let the tax tail wag the investment dog. There's a lot of investment merit, especially for income-seeking investors, including MLPs and REITs and other instruments like this in your portfolios, these higher yielding stocks. But I do believe they should be done at a limited basis, okay? So, because they are different and are unusual. But this is an extremely high quality one here. So one of the things that I went into the company's corporate website directly through FastGraph, and I already loaded this up. I went into Investor Services, and then I went into their most recent investor deck or investor presentation, which was August of this year or last month. So this is a very, very comprehensive investor deck, I might add. And you can get a lot of information. So the company trades natural gas liquids, or ships natural gas liquids, crude oil, natural gas, petrochemicals, and refined products. And you can see they have 50,000 miles of these pipelines out there. And they have 260, I guess that's, barrels of natural gas liquid, petrochemical, refined, etc. They have 19 natural gas processing facilities, 25 fractionators, 11 condensate distillation facilities, and so on. The point being is that you can learn an awful lot about what this company does and what its breakup is. Now, they have this interesting slide here that says, why enterprise product? And, first of all, they argue that they're built for the long run, and I think that's really true. In fact, they're borrowing money at a 57-year maturity right now at about 4.5%. So that, says that investors are willing to, trust that they've got a long-term future ahead of them. Their market cap is over $50 billion. Their enterprise value about $79 billion as of when this was produced. Those numbers are slightly different now. It's a triple B plus rated by Standard & Poor's, Baa1 by Moody's. It's had 22 consecutive years of distribution increases, and they have proven to be a very disciplined allocator of capital. And their cash flow allocation has also been very interesting, as I'll show you. So, they have very good distribution coverage, as I mentioned. The company really has often what I consider to be one of the safest dividends out there. But there's a lot more. Now, you can get in and learn a lot about the details. And I'm not going to spend the time on this video doing that, but I want you to see that this presentation is really worth going into. Now, they do have 4 business segments: the natural gas liquids, crude, natural gas, and petrochemicals. Now, I went into Zacks Research here, and Zacks Research is a service that I personally subscribe to, and they talk about the things I've already talked about, the 50,000 miles of pipelines. But what they also do is they break down their business, okay? So they, have 4 segments, as Zacks points out. They have the natural gas pipelines, crude oil, natural gas and services, and petrochemical. The natural gas liquid pipeline and services, by the way, represent 51% of their 2020 gross operating income. Okay, that's, their biggest segment. It has 26 natural gas processing plants and 19,000 miles of pipelines. Then crude oil pipelines and services, or shipping of oil, is 24.4%. Natural gas pipelines and services, 11.4%. And again, that's at 19,000 miles of natural gas pipeline I talked about. And then petrochemical and refined products, 13.2%. And this is, incorporates things like propylene production facilities and others, butane, etc., which is part of the natural gas liquids process. But going back to their presentation here, they have really a lot of safety and a lot of sustainability, and you can get into that by going through this presentation. Again, I'm not going to spend a whole lot of time. What I really want you to see here is that there's a lot of very comprehensive information available on Enterprise Product Partners. Okay, but let's go back to the fast graphs here. And I'm using the new version, which we're getting, guys. I know I keep saying, I know I sound like a broken record, and I know it's been frustrating, but we're getting real close. We're starting to really test a lot of these things. And as I mentioned in yesterday's videos, one of the areas that we're working on is getting the fund graphs, the financial underlying numbers and the financial statements with some many improved metrics on it, which I'll kind of showcase here, a few of them in a moment. But I do want you to see this huge surge in operating cash flow. Okay, and I want to talk about why that happened and what I found it very, very interesting. So I'm going to go to the in millions graph. So I'm not using per share data here. I'm using what I also call gross data. All right, and the first thing I want you to see as I go through this, and one of the things that were added to the financial underlying numbers, we've got basic shares outstanding and diluted shares outstanding. We used to only have what we called common shares outstanding. I do want you to note, though, for most companies, you're going to see those entities tend to be very, very similar, if not the same. The preferred one to use is diluted because that eliminates, all dilution of the shares. And what I want you to see here is that in 2008, the company went from 875,200,000 shares, and they bought down to 413,400,000 shares. So they roughly cut their share count in half here. Now, that's very interesting for a couple of reasons here, because what happened was simultaneous to that, if I go to their balance sheet here and look at long-term debt, I also want you to note that the company took on an enormous amount of debt at this time. Their debt went from $6,900,000,000 to $11,600,000,000 right in here. Okay, so that also gave them significant amounts of cash and cash flow. All right, so that the company was, really increased their borrowing costs a great deal. But what's very interesting, if I move into the per share data here, okay, and I look for, what the company actually did, if I go down to dividends per share, okay, and look at dividends per share, I want you to note that their dividend income per share grew over this time, went from $1.02 to $1.08 to $1.14 and so on. Okay, so that was, that they were able to maintain their dividend. But what's interesting about that, if I go back to the million shares, the in millions here, and look at common dividends paid, their actual common dividends went from $1 billion down to $266 million. Remember, they cut their share count in half during that time, which gave them great share count coverage. All right, they were able to, easily pay the dividends. Their cash and short-term investments also increased dramatically during that period of time, as you can see here. So the company was able to maintain their distributions, very shareholder-friendly action that they took coming out of the Great Recession here, which kind of makes their cash flows look a little weird, as I pointed out earlier, where you had this huge surge in cash flow, but it kept this dividend streak alive. It was very shareholder-friendly. It was anti-dilutive to the existing outside shareholders, and it showed that management kind of aligns themselves, and that's something that a lot of these research services, for example, like Morningstar, talks about it. If we get into the company's capital allocation, okay, they talk about the management being an exemplary capital allocators, that's part of what it was. In a difficult industry environment, Enterprise has remained conservative and sensible stewards of capital. And this is a tactical executive team that plays the long game. I think that's a very important statement right there. These guys are in it for the long run, and they tend to be very, very shareholder friendly. They retain sufficient distributable cash flow to reinvest in the business while limiting reliance on dilutive equity and debt capital market issuances. However, they have raised some capital in recent years, but they also have recently announced that they're going to be buying back about $200 billion worth of shares coming up here in the very near future. From a standpoint of fair value, Morningstar gives them a $25.50 fair value, and that's quite a bit lower than I would. I would say if I look at the normal way the market has been valuing this stock here, looking at the normal multiple, I would put the fair value of the company at closer to $36. And this is where I, indicated that there's about a 65% margin of safety here approaching. It's 58 to to 65%, meaning if the stock traded at its normal multiple, the normal market multiple of 10.7 times earnings, which is, even a little lower than what I'm showing right here, then you would have this tremendous upside, in the company going forward. The growth is expected to average about 6% over the next couple of years, a big growth for this fiscal year, followed by actually negative growth next year, but that still gives us an incredible long-term rate of return potential, being aggressive, looking at a 15 multiple on the shares. And if I go back to the normal multiple, I still have about a 48, almost 49% total annualized rate of return potential on this stock over the next year or two. And I've got an 8.23% dividend income yield, while I'm waiting for that. So I consider this to be a very interesting income vehicle. And I want to basically look at it from a standpoint of historical performance, because I think that's critically important. Now, I talked about this a lot yesterday's video, and I'm going to talk about it again. You got to know what you're investing for. The reason for investing in a stock like EPD is for this income generation. They do provide some capital appreciation, as I'll show you here in a moment. But the big thing is the amount of income this company is, or this business is capable of generating on their shareholders' behalf. Now, looking at historical data, a $10,000 investment made on December 29th, 2000 would have generated $31,578.95 of dividend income, compared to only $4,692 had you invested in the average company represented by the S&P 500. I really want to focus on this. These MLPs are incredible income producers. All right, now that $10,000 would have generated 5% annualized growth, if you will, turning $10,000 into $27,839.24. Now, to put that into perspective, remember you invested $10,000, so you got $17,839 of capital gain, if you will. All right, but you got $31,000 of dividends, so you got almost twice as much dividend income than you did capital appreciation. That is the benefit of investing in these master limited partnerships. That shoots your total annualized rate of return up to $59,418.19, or a 9% annualized rate of return, which actually outproduced the market on a total return basis over this time frame. However, it underproduced it on capital appreciation. It's all about the income in investing in these things. Now, I often get asked this question about, what if I reinvested the dividends? And you could obviously do that. You can reinvest the dividends, and FastGraphs actually facilitates that. You can go into the additional settings section of FastGraphs. You can hit reinvestment dividends at end of quarter. That's what EOQ stands for. And then apply those settings to this. And what will happen is you'll notice that your share count jumps up each year tremendously. And now that $10,000 investment would have generated $71,319 of dividends, versus reinvesting dividends in the S&P would have given you, increased it to $58.91, and your $10,000 investment, the total return, including all the dividends reinvested, would have been $51,415 versus $101,000, or 11.8% versus 8.5%, by investing in this literally slower growing but high yielding Enterprise Products Partners Master Limited Partnership. So, this is a really excellent income vehicle for the long run. It has a great long-term dividend streak. It is extremely undervalued, in my opinion. Even if you use just the dividend income line that I referenced earlier, you could see that there is a margin of safety in buying this, stock today. Looking at it as far as what's happening with it today, we've got this kind of down market going on. I think that's creating some opportunities to make some nice investments. Hopefully we're going to get some better opportunities in some of the overvaluation I talk about all the time. But regardless, Enterprise Product Partners is an excellent income vehicle. It does come with a K1. You do have to, take that into consideration. And I do think you need to understand the product a little bit also, because these limited partnerships, as I was pointing out when I went through some of the financials here, they're different animals. Anyway, this has been Chuck Carnevale saying I hope you enjoyed this high-yielding income opportunity that I presented here. Enterprise Product Partners, very high-quality master limited partnership. Energy is going to be around for a long time. If you go through that slide deck, they talk about that quite a bit. So I don't think there's any imminent danger of, a company like this not being a viable investment for probably decades to come, but certainly for many years to come. Anyway, I hope you liked this video. Hope you found it enjoyable and interesting and enlightening at the same time. If you did, ring the bell, give me a like and subscribe to the channel if you haven't already, so that we can continue to bring you more videos like this on good investment opportunities, good value investment opportunities, I might add. Thanks for watching.